All right, guys, something just shifted, and the market is only beginning to register what it actually means. In just days, Beijing is moving to tighten control over silver exports, and this single decision is quietly sending shockwaves through the U.S. semiconductor sector, not because silver is a flashy headline commodity, but because it sits at the invisible foundation of everything that makes modern AI and advanced chips work. When you strip away the hype around AGI and trillion parameter models, you are left with a much more uncomfortable reality. Chips do not run on ambition. They run on materials, energy, and cost discipline, and silver is embedded across that entire stack. This is why panic is creeping in. U.S. chipmakers are realizing that this is not a trade headline. It is a structural signal. For years, Washington believed the advantage lay in staying a generation ahead in design. Faster nodes, bigger models, more compute. But now the ground beneath that strategy is starting to move. If silver flows tighten, costs ripple instantly through data centers, power systems, sensors, connectors, and high-efficiency electronics. That feeds directly into margins, timelines, and deployment scale. This is not theoretical, it is mechanical. The reason this moment matters is because it exposes a deeper vulnerability that markets have mostly ignored. The U.S. tech stack assumes unlimited access to cheap inputs somewhere in the system. That assumption is no longer safe. China does not need to outdesign NVIDIA or outbrand Silicon Valley to change the equation. It only needs to control a few quiet choke points long enough for cost pressure to do the rest. And that is exactly why semiconductor executives are nervous. They are staring at a scenario where their chips remain world-class on paper, but increasingly expensive and harder to deploy in reality. This is not about one metal, it is about leverage. And once leverage is applied, it rarely stays isolated. This is the opening move of a longer game, and most investors are still treating it like noise. It is not. It is the first visible crack in a system built on the assumption that supply chains will always remain neutral. To understand why this moment is so dangerous, you have to zoom out and look at the real structure of the AI race. There is a comforting narrative that says this competition will be decided by who builds the smartest model or reaches artificial general intelligence first. That story is emotionally satisfying, but it is strategically incomplete. The real contest rests on a quieter foundation. Inference, cost control, materials, and energy form the actual bottleneck. Training a massive model is impressive, but deploying AI at scale is what creates power. And deployment depends on reliability, latency, efficiency, and price. This is where the hidden choke point emerges. Inference chips need to be cheap enough to spread everywhere, efficient enough to run continuously, and reliable enough for hospitals, factories, grids, and logistics systems. Silver is not optional in that equation. It is woven into high conductivity pathways, power management systems, advanced connectors, and thermal control. There is no easy substitute at scale. Now contrast the two strategies. The U.S. approach has been to push the frontier outward. Bigger models, more compute, higher capital intensity. China, constrained by sanctions and cost ceilings, took a different route. It optimized downward. It focused on making AI usable, affordable, and embedded into everyday systems. That divergence matters because when materials tighten, the side that already lives close to cost efficiency adapts faster. The side that depends on abundant cheap inputs feels the shock first. This is why silver export controls land differently than chip bans. Chip bans slow progress. Material constraints reshape behavior. They force prioritization. They punish waste. They reward systems that were built lean from the start. This is the core frame you need to hold. The AI race is not being decided at the cutting edge, it is being decided at the deployment layer. And deployment lives and dies by cost, energy, and materials. Silver just happens to be the pressure point that makes this reality impossible to ignore. Once you apply that frame, the first evidence chain becomes clear. Inference is the real battlefield. Training happens occasionally, inference happens constantly. Every query, every image, every decision runs through inference hardware. That hardware must operate with ultra-low latency, predictable timing, and minimal power draw. This is where practical advantage accumulates. China leaned into this early out of necessity. Unable to afford endless training runs on bleeding-edge chips, it focused on squeezing maximum utility from every watt and every component. The result is an ecosystem optimized for real-world use rather than theoretical benchmarks. The first-order consequence is speed of adoption. When inference is cheap and efficient, AI spreads into manufacturing, healthcare, transport, and public services far faster. The second-order consequence is feedback. Widespread deployment generates data, refinements, and operational experience that compound over time. This is how systems mature. Meanwhile, much of the US AI stack remained oriented toward scale and spectacle. Incredible models, enormous capital burn, and infrastructure that assumes stable inputs. When silver costs rise or availability tightens, inference hardware becomes more expensive. That slows rollout. Slower rollout delays feedback. Delayed feedback weakens long-term competitiveness. None of this requires China to win a headline battle. It only requires time. And time favors systems that can operate cheaply under constraint. This is why US chipmakers are anxious. They are not losing capability, they are losing frictionless deployment. And in AI, friction is fatal. The side that can place intelligence everywhere quietly and affordably shapes the environment. The side that cannot is forced to concentrate power in fewer hands and fewer locations. That is not dominance. That is fragility. And this is why the silver move matters far beyond commodity markets. It strikes directly at the layer where AI becomes real. Once you move past inference and software, the next layer of pressure becomes impossible to avoid, and that layer is industrial capacity. Advanced chips do not exist in isolation. They are born, tested, refined, and optimized inside physical systems made of factories, tooling, logistics, skilled labor, and dense supplier networks. This is where the gap between the United States and China becomes structural rather than technological. China's advantage is not that it has better factories in isolation, it is that it has more of them, closer together, feeding into each other continuously. When an inference chip needs redesign for efficiency, the feedback loop between design, manufacturing, and deployment can compress into months instead of years. That speed matters. The United States, by contrast, has spent decades allowing its industrial base to thin out. Fewer factories means fewer iteration cycles. Fewer cycles means slower optimization. The first-order consequence is that even when American firms design excellent chips, translating those designs into cost-optimized mass deployment takes longer. The second-order consequence is compounding disadvantage. Slower iteration raises costs. Higher costs reduce adoption. Lower adoption weakens the incentive to invest in further optimization. This becomes a loop that feeds on itself. Tariffs, labor shortages, and fragmented supply chains add friction at every step. Meanwhile, China's industrial ecosystem acts like a pressure vessel. Constraints do not break it, they force it to adapt inward. This is why industrial capacity matters more than press releases about reshoring. You cannot shortcut density. You cannot substitute policy slogans for physical throughput. Semiconductor anxiety is rooted here. Executives understand that controlling design leadership is not enough if manufacturing speed and cost control sit elsewhere. When materials like silver tighten, this imbalance becomes sharper. The system with more factories absorbs shocks. The system with fewer factories feels them immediately. This is not ideology. It is physics applied to economics, and physics always wins in the end. Layered directly on top of industry is the most unforgiving constraint of all: energy. AI does not run on code alone. It runs on electricity and enormous amounts of it delivered reliably, cheaply, and without interruption. This is where the theoretical power of advanced chips collides with physical limits. The United States has world-class processors, but it is increasingly constrained by how much power it can generate and distribute. Data centers do not care how advanced a chip is if electricity is expensive or unstable. China understood this early. It expanded power generation across every available channel. Fossil fuels, hydro, solar, wind, and nuclear were all treated as strategic assets rather than ideological choices. The result is scale. The first-order consequence is simple. More available power allows more chips to run at higher utilization. The second-order consequence is decisive. Higher utilization lowers per-unit cost of AI deployment, which accelerates adoption and refinement. In the United States, the opposite pressure is building. Grid bottlenecks, rising energy costs, and slow permitting create invisible ceilings. You can install cutting-edge chips, but you cannot always run them at full capacity. That gap erodes advantage quietly. When silver costs rise, the problem compounds. Silver is critical not only inside chips, but across power transmission, cooling systems, and grid hardware. Higher silver prices mean higher infrastructure costs. That delays upgrades. Delayed upgrades constrain power availability further. This is how energy becomes a force multiplier for material constraints. It does not need to fail outright. It only needs to become more expensive and slower to expand. In that environment, the side with surplus power keeps moving forward while the other negotiates limits. AI dominance is not about who has the best chip. It is about who can keep the lights on cheaply enough to use them everywhere. All of these pressures converge once you focus on silver itself. Silver is not a speculative add onto modern technology. It is embedded deep inside electronics, power systems, sensors, batteries, and military hardware. Its conductivity, reliability, and durability make it extremely difficult to replace at scale. When China signals tighter export controls, markets react not out of panic, but recognition. This is a material with no easy substitute and rising structural demand. The first order effect is cost. Higher silver prices raise the input cost of chips, power systems, and industrial electronics. Margins compress, budgets stretch, projects get delayed. The second order effect is strategic behavior. When arbitrage channels open, silver flows toward the highest priority users. Countries and firms begin stockpiling. That reduces availability elsewhere, reinforcing scarcity. China benefits twice. It secures low-cost supply for its own industries while forcing competitors to pay a premium. This is not an embargo. It is far more effective. It reshapes incentives without triggering immediate retaliation. For the United States, this lands at a fragile moment. Industrial rebuilding is already expensive. Energy expansion is already constrained. Add rising material costs, and the entire system becomes heavier. More capital is required just to stand still. That capital must be borrowed, subsidized, or printed. Over time, that pressure bleeds into inflation, debt, and political tension. This is why silver matters far beyond commodities. It exposes how dependent advanced economies remain on physical inputs they do not fully control. The anxiety in the semiconductor sector is rational. This is not a temporary spike. It is a signal that the era of frictionless access to critical materials is ending. And once that era ends, every strategic calculation has to change. Once you step outside the narrow frame of US versus China, the picture becomes far more complex and far more revealing. What we are witnessing is not a bilateral dispute, but the slow formation of a commodities-centered geopolitical order. Groups like BRICS matter here not because of slogans or summits, but because they sit on the physical inputs modern economies cannot function without. Silver is only one example, but it illustrates the pattern perfectly. Control over extraction, processing, transport, and financing is becoming as important as control over technology itself. Infrastructure projects, port investments, and long-term supply agreements are not random acts of development. They are insurance policies. When supply chains fragment, access becomes power. China understood this years ago and positioned itself accordingly. By embedding itself across resource-rich regions, it reduced its exposure to external pressure while increasing the exposure of others. The first-order consequence is resilience. When markets tighten, China can prioritize domestic industry without triggering immediate collapse. The second-order consequence is leverage. Partners dependent on Chinese demand or infrastructure become more cautious about confrontation. For the United States and its allies, this shift is uncomfortable because it undermines assumptions built during an era of abundance. The global economy is no longer a single integrated system optimized for efficiency. It is evolving into overlapping spheres optimized for security and continuity. That transition raises costs everywhere, but it advantages those who planned for it early. Silver flows illustrate this fragmentation in real time. Material moves toward political alignment rather than price alone. This is not ideology, it is adaptation. And as this pattern spreads beyond silver into copper, rare earths, and energy inputs, the rules of competition change. Technology leadership remains important, but it is no longer sufficient. Without assured access to the physical layer, digital power floats without foundation. This is the pivot many analysts missed. The AI race is being nested inside a broader resource realignment. Ignore that, and every forecast becomes fragile. From this point forward, there are three plausible paths, and none of them are painless. The first path is escalation through spending. The United States responds by pouring even more capital into subsidies, industrial policy, and emergency supply chains. This keeps capability alive, but at rising cost. The first-order effect is temporary stability. The second-order effect is inflationary pressure and debt expansion that slowly erodes flexibility. The second path is fragmentation. Supply chains split more clearly along political lines. Efficiency drops, redundancy rises, and prices remain structurally higher. The first-order effect is resilience within blocks. The second-order effect is slower global growth and more frequent shocks. The third path is counterintuitive. The United States does not lose technological leadership outright. Its chips remain among the best in the world. But it loses time. Deployment slows, costs rise, adoption concentrates instead of spreading. China, operating under constraint, continues optimizing downward. Over years rather than months, this produces an ecosystem that is less glamorous but more embedded. In this scenario, dominance is not declared, it simply accumulates quietly. None of these outcomes require dramatic conflict. They unfold through budgets, procurement decisions, and infrastructure timelines. Markets often underestimate this kind of change because it lacks a single trigger. But once momentum builds, reversal becomes difficult. This is why silver export controls matter, even if they appear modest at first. They are part of a broader signal that material security is being prioritized over market openness. That signal will shape behavior long after the headlines fade. So we end where we began, not with a metal, but with structure. The anxiety rippling through the semiconductor sector is not about one policy decision or one quarter of earnings. It is about the realization that the foundations of technological power are shifting. AI supremacy does not rest solely on who designs the smartest chip. It rests on who can deploy intelligence cheaply, continuously, and at scale. That requires industry, energy, and materials moving in harmony. Silver exposed the fault lines because it sits at the intersection of all three. This moment should be read as a warning, not a verdict. Systems can adapt, strategies can change, but adaptation is slower and more expensive than prevention. The era when advanced economies could assume frictionless access to critical inputs is ending. What replaces it will be defined by preparation, not promises. The question now is whether policymakers and industry leaders recognize the nature of the challenge before constraints harden into limits. And for everyone watching this unfold, two questions matter above all others. Can the United States reconfigure its industrial and energy base fast enough to keep deployment friction low? And will China's focus on materials and infrastructure quietly outweigh headline technological breakthroughs? Let me know what you think in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through these crazy times. 8 to 9.